The silver arbitrage is broken. Why $75 silver in Shanghai signals a global financial reset. If you were to look at the global financial dashboard in late December 2025, you would see a flashing red light that defies the fundamental laws of modern economics. A discrepancy so glaring that it suggests the mechanism of global trade has fractured. On the screen of the Shanghai Gold Exchange, silver is trading at a price that converts to approximately $78.55 per ounce. Meanwhile, on the COMEX in New York and the LBMA in London, the screen price hovers near $69. This is not a rounding error, nor is it a temporary flicker of volatility. This is a gap of nearly $10, a premium of over 10%, persisting between the world's two largest economic blocs. In a functioning market, traders would instantly buy the cheap silver in New York and sell it in Shanghai, closing that gap within seconds while pocketing the difference. That is the definition of arbitrage. It is the gravity that holds global markets together. But in late 2025, gravity has stopped working. The arbitrage gap is not closing, it is widening. What we are witnessing is the Great Divergence, a historic dislocation that signals the end of paper-based price discovery and the violent return of physical reality to the commodities markets. The failure of arbitrage to close this gap exposes a terrifying truth for the Western financial system. You cannot ship what you do not have. The reason traders are not flooding Shanghai with Western silver to capture that massive profit is that the physical metal in the West has effectively vanished, trapped in a web of inventory depletion, regulatory blockades, and a desperate scramble for industrial sovereignty. To understand how we arrived at a world where silver trades at $75 in the East while the West pretends it is still under $70, we must peel back the layers of a crisis that has been building for years, driven by a perfect storm of policy weaponization, industrial exhaustion, and the collapse of trust in paper promises. The story of this divergence begins in the vaults. For decades, the illusion of abundance was maintained by massive stockpiles in London and New York, which allowed bullion banks to manage prices through paper derivatives. But as we closed out 2025, the illusion shattered. The registered silver inventories at the COMEX, that is, the metal actually available for immediate delivery, have plummeted by over 70% from their peaks in 2020. In a single, frantic 96-hour window in late 2025, market insiders watched in disbelief as 60% of the remaining registered silver was withdrawn from the COMEX vaults. This was not a standard commercial rotation, it was a run on the bank. The physical liquidity required to facilitate arbitrage has evaporated. When lease rates for silver spiked to 200% annualized, as they did during the height of this squeeze, it screams that the metal is not just scarce. It is unavailable at any price the paper market is quoting. This vacuum in Western vaults is the primary reason the $75 price in Shanghai remains untouchable. If a trader in New York cannot secure physical bars to put on a plane, the price difference becomes irrelevant. The bridge has been burned. But the supply crisis is only half the equation. The other half is a deliberate, calculated weaponization of regulatory policy by Beijing, designed to trap strategic resources within China's borders. On October 26, 2025, the Chinese Ministry of Commerce, known as MOFCOM, dropped a regulatory hammer that fundamentally altered the flow of global metals. They issued Announcement 2025 No. 68, a directive that effectively ends the free export of silver, alongside other critical minerals like antimony and tungsten, starting January 1, 2026. Under this new regime, only large, state-approved enterprises with massive production thresholds can export silver, and even then, they must prove that the export aligns with national strategic interests. This is not merely a trade tariff, it is a resource blockade. By restricting the outflow of silver, China has turned its domestic market into a roach motel for precious metals. Silver can check in, but it cannot check out. This regulatory wall ensures that the massive premium in Shanghai does not leak out to the rest of the world. It incentivizes importers to bring metal into China to capture the higher price, but once it arrives, it stays there to feed the voracious appetite of the Chinese industrial machine. To reinforce this wall, Beijing implemented a subtle but devastating fiscal reform in November 2025 regarding the value-added tax or VAT. For years, a VAT offset allowed retailers and fabricators to recoup a significant portion of the taxes paid on gold and silver, keeping liquidity flowing. That offset was slashed from 13% down to 6% for non-investment withdrawals. While this sounds like dry tax policy, its impact was electric. It effectively increased the cost of withdrawing physical metal from the Shanghai Gold Exchange for industrial or jewelry use, creating a fiscal barrier that traps liquidity within the exchange system. This additional cost burden is baked into the Shanghai price, pushing it further away from the international spot price and solidifying the arbitrage gap. The message from Beijing is clear. The silver produced in China and the silver imported into China is for China. The driving force behind this desperate hoarding is not a fascination with shiny rocks, but a cold calculation regarding the future of energy and technology. The industrial demand for silver has become inelastic, meaning it does not drop just because the price rises. You simply cannot build a high-efficiency solar panel, an electric vehicle, or an AI-capable data center without silver. In 2025, the global deficit, the gap between what we mine and what we use, hit nearly 200 million ounces for the year, pushing the cumulative 5-year deficit toward a staggering 800 million ounces. This is metal that has been consumed, locked away in landfills or embedded in electronics, largely unrecoverable. The solar industry alone is consuming silver at a rate that terrifies supply planners. The shift to newer, more efficient solar technologies like TOPCon and heterojunction cells has increased the amount of silver required per watt of energy produced. China, which dominates the global solar supply chain, knows that its energy ambitions depend on securing this metal. They are not hoarding silver to manipulate a currency. They are hoarding it because they view it as a strategic energy metal, as vital as oil or uranium. The great divergence in price is essentially China paying a premium to secure the inputs for its future dominance in green energy and high-tech manufacturing. They are willing to pay $78 an ounce when the West pays $69 because, for them, the cost of running out is far higher than the cost of the metal. This creates a bifurcation of reality. In the West, financial managers and algorithmic trading systems still view silver as a legacy monetary asset or a volatile commodity to be traded on leverage. In the East, it is viewed as a critical component of national security. This clash of worldviews came to a head on what traders are calling Black Friday 2025. On that day, the infrastructure of Western pricing power seemed to buckle physically. Both the COMEX and the LBMA suffered simultaneous technical shutdowns, officially blamed on cooling system failures at data centers. Market veterans were immediately skeptical. The idea that redundant cooling systems at major financial exchanges would fail simultaneously, exactly when a reported 400 million ounce delivery demand was hitting the market, seemed implausible to many. Rumors swirled that the shutdown was a force majeure event designed to prevent a default, masking the fact that the exchanges simply did not have the silver to meet buyer demands. Whether a true technical glitch or a cover-up, the result was the same: a total loss of confidence in the paper price. If you cannot trust the exchange to stay open, and you cannot trust the inventory data because reports have been suspended, you stop trading paper and start buying physical. This is why the Shanghai price, which represents physical delivery, has decoupled from the COMEX price, which increasingly represents a digital fiction. The behavior of major market actors further confirms this shift. JP Morgan, a titan of precious metals trading, has been observed shifting its strategy. Historically associated with large short positions that suppressed prices, reports suggest the bank, and others like it, have pivoted toward massive physical accumulation, effectively front-running the crisis they helped manage. They are moving operations and focus toward Asia, specifically Singapore and Shanghai, recognizing that the center of gravity for price discovery is shifting east. When the biggest whales in the ocean stop betting against the price rising and start hoarding the asset, it is a signal that the game has changed. This is not just a China story, it is a BRICS story and specifically an India story. While China locks the doors on exports, India has kicked down the doors on imports. In October 2025 alone, India imported a record-shattering 1,700 tons of silver. Indian buyers, culturally attuned to the value of physical metal and sensing the same shortage, drained what was left of the LBMA vaults in London. This massive transfer of wealth from west to east is the mechanism of the shortage. The West sold its silver cheap, and the East bought it all. Now, with the vaults empty, the West is waking up to a reality where they must pay the Shanghai price if they want the metal back. But China isn't selling. The implications of this arbitrage gap extend far beyond the price of a silver coin. It represents a fractal breakdown of the market structure itself. Traditional financial models, based on the efficient market hypothesis, assume that arbitrage will always smooth out these inefficiencies. But recent analysis using fractal market hypotheses suggests that we have entered a chaotic regime where linear pricing models no longer apply. In this new environment, price changes happen in violent steps rather than smooth curves. The jump from $28 to $67 in a single year, and the subsequent decoupling of Shanghai is a structural break event. It indicates that the market has moved from a state of liquidity to a state of scarcity, where momentum and physical necessity override financial logic. We see this same pattern replicating in other critical materials, confirming that the silver crisis is part of a systemic resource war. Look at antimony, a critical mineral for military ammunition and flame retardants. China produces the vast majority of it, and following similar export restrictions, the domestic Chinese price is roughly $20,000 per ton, while the international price has screamed past $40,000. The arbitrage gap there is even more extreme, a 100% premium outside China, because the export ban is total. The metal wars are being fought on multiple fronts, and in every case the dynamic is the same. China secures domestic supply at a managed price, while the rest of the world fights over the scraps at hyperinflated valuations. Even the copper market, the bellwether of the global economy, is showing these stress fractures. Premiums for copper cathode in Shanghai reached record highs in late 2025, driven by low inventories and disruptions in African supply chains. The Great Divergence is not a glitch. It is the new operating system of the global commodities market. It is a system defined by resource nationalism, broken logistics, and the bifurcation of the world into those who have the physical material and those who have the paper currency to pay for it. So where does this lead? If the arbitrage gap cannot be closed by moving metal because there is no metal to move, it must be closed by price. The Western paper price must rise to meet the physical reality of the East. Analysts are now openly projecting a move to triple digits, silver at $100 or more, in the 2026-2027 window. This is not speculation based on charts. It is a mathematical necessity to destroy demand. The only way to balance a market with a 5,000-ton annual deficit and inelastic supply is to push the price so high that industrial users are forced to find alternatives or shut down production. But as we noted, for high-tech industries, there are no easy alternatives. You cannot substitute silver in a high-performance chip or a solar cell without degrading performance. Therefore, the price has no ceiling until new supply can be brought online, a process that takes a decade, not months. The primary silver miners, the companies that actually dig the metal out of the ground, are the only ones holding a winning hand in this high-stakes game. Because 75 to 80% of the world's silver comes as a byproduct of mining lead, zinc, or copper, the supply is inelastic. A copper miner does not care if silver goes to $100 if copper collapses. They will not mine more. This leaves the pure-play silver miners as the strategic assets of the new era. Companies that can deliver high-grade silver concentrate are commanding premiums that defy historical norms, because refiners and industrial end users are desperate to secure a direct line of supply that bypasses the broken exchange system. The arbitrage gap of late 2025 is the tombstone of the old financial order. It marks the moment when the artificial suppression of precious metals, prices through unlimited paper leverage, finally collided with the hard wall of physical scarcity. The $75 price on the Shanghai screen is not an anomaly, it is the truth. The $69 price on the COMEX screen is the ghost of a system that has run out of time and metal. As we move into 2026, with export bans locking the gates and industrial demand accelerating, the world is about to learn a very expensive lesson in the difference between price and value. The price is what you pay, the value is having the metal in your hand when the music stops. And right now the music has stopped, the vaults are empty, and the only chair left is in Shanghai. This phenomenon forces us to reconsider the very nature of money and reserves in the modern era. For decades, the US dollar's hegemony allowed Western nations to export inflation and import real resources. But the silver market is signaling a reversal of this flow. By paying a higher price, China and the East are effectively draining the West of real assets, exchanging paper currency for strategic metals. This accumulation is a central pillar of the BRICS strategy to de-dollarize the global trade system. If you hold the physical gold and silver, you hold the collateral for the next financial system. The frantic buying by India and the strategic hoarding by China suggest that they view the current price, even at record highs, as a bargain compared to the future purchasing power of fiat currencies. We must also scrutinize the role of the Black Friday technology failures. In a highly digitized, algorithmic financial system, a cooling failure that shuts down the two most important precious metals exchanges simultaneously is a statistical improbability that borders on the impossible. It breeds a level of distrust that fundamentally breaks the market psychology. If traders believe that the exchange will pull the plug whenever the physical demand gets too high, they will abandon the exchange. This is known as Gresham's law in reverse. Good money, physical silver, goes into hiding, while bad money, paper contracts, circulates until it becomes worthless. The Shanghai premium is essentially the cost of getting out of the bad money system. Furthermore, the impact on the green energy transition cannot be overstated. Western governments have mandated a transition to renewable energy that is mathematically impossible without massive inputs of silver. By allowing their strategic stockpiles to be drained and failing to secure domestic supply chains, Western nations have inadvertently handed the keys to the energy transition to China. If China controls the silver export market through quotas and licensing, they control the pace at which the West can deploy solar panels. The arbitrage gap is effectively a tax on Western decarbonization, levied by Beijing. The situation is further complicated by the internal dynamics of the mining industry. As noted, the inelasticity of supply is a critical vulnerability. In a normal commodity cycle, high prices stimulate more production. If the price of oil doubles, drillers drill more. But silver is different. Since the vast majority is a byproduct, a high silver price does not necessarily lead to more silver mines. It takes years to permit and build a mine. The current pipeline of projects is woefully insufficient to meet the projected 5,000-ton deficit. This means the gap is structural. It cannot be fixed by market forces alone. It requires a complete reevaluation of how we value strategic minerals. As we look toward 2026, the divergence is likely to become the new normal. The Great Divergence is not closing, it is institutionalizing. We are likely to see a fragmented global market where regional prices bear little resemblance to each other, separated by tariff walls, export bans, and currency blocks. The illusion of a single global price for silver is dead. In its place is a fractured landscape where possession is the only law. The $75 Shanghai silver price is a siren warning of a collapse in global logistical and financial trust. It exposes the fragility of a system built on just-in-time delivery and infinite paper leverage. For the investor, the industrialist, and the strategist, the lesson is stark. The era of cheap, abundant resources flowing freely from west to east is over. The flow has reversed. The vaults are bare, and the price on the screen is only relevant if you can take delivery. In Shanghai at $75 you can. In New York at $69, you are buying a promise that the market can no longer keep. The arbitrage is broken, and with it, the old world order.